Today, I'm going to show you the exact strategy that I used to go from $0 to over 500K in just 9 months. So if you've been a part of my channel since the beginning, you see my life change drastically. I went from living with my parents to moving into a $2 million neighborhood, traveling across the world and driving Lamborghinis. And the reason why I was able to accomplish so much in so little time is because of this strategy called supply and demand trading. Now, there's a lot of people that teach supply and demand, but I came up with my own method that changed my life forever. Not only did it change my life, but I have students getting results every single day. I'm seeing students go from nothing to getting funded to getting payouts. It's really amazing all the lives that have been affected just from me making this strategy and putting it out to the world. So by the end of this video, you'll know the exact same strategy that I use so you can go use it and potentially change your life. Let's get into it. Before we get into this video, I gotta let you guys know that the Forex Funder is back and better than ever. You can use MatchTrader, CTrader, TradeLocker, whatever you prefer to use, they got it. And yes, they are servicing the USA. So I'll put the link down below. Make sure you use the code OFFER60. You can get 60% off your challenge right now. So there's a lot of styles in the Forex community right now. We got breakout trading, we got support and resistance trading, we got ICT trading. There's countless and countless of strategies, and I can tell you, I've tried most of them. And even though you will win a couple trades just long term, you're not going to get the results you're looking for. I've literally taken everyone's course, everyone's mentorship, and until I made my own strategy, nothing was working. I don't need you to take my word for it. Just put this strategy to use and I'm sure you'll see some results. Supply and demand is the way that the market moves. I'm gonna make this very simple. When you're looking for supply zones, we're looking for sales. When we're looking for demand zones, we're looking for buys. So as soon as you hear supply, it's just another word for sales. As soon as you hear demand, it's just another word for buys. No need to complicate it. That's all you need to know. So when you see a very strong supply or demand push, that just means a whole bunch of liquidity was just pumped into the market. So we know that the banks are trading at this level, so we definitely want to get in that level when it comes back. So now let me show you on the charts. Okay, so we're just on a random chart. This is Euro USD, and you can see right here, this is a perfect example of a demand push. Price was going sideways, the banks entered, they pumped in a whole bunch of liquidity, price shot up like crazy. Right now it takes billions of dollars to do this. So when we see that they entered right here, we know that once it comes back to this zone, we want to be entering right here. As you can see, price went up. Very simple. Let's look at some supply zones. Now let's look at some supply examples. You see this big candle right here? I would consider this a supply zone. We have one red candle, two candles. I would consider that a supply zone. Same thing right here. I would consider this a demand zone. It could be one candle if it's very large, but we want it to be 3 candles most of the time. So let's find a good example. So look at this right here. 1 candle, 2 candles, 3 candles, and it's very large, right? So this is definitely a supply zone. So we definitely would want to take a trade once it comes back up here to sell it down. Now, not all the time is it gonna just come here and then sell it down and you could just enter a trade, right? It could just shoot right up, but that's why we have other confluences that we'll get into in a little bit. But right now, I'm just gonna show you what a supply zone is. So now that we know that the banks and liquidity providers made the market drop right here, we would call this a supply zone, right? So this is our supply zone. So we know that when we get in this area, price likes to drop. Even if you drag this to the left, you can see right here, price came in this area and dropped. So now we're building a story, right? So let's look at some more examples. So right here is a very strong demand push, right? All these candles right here is a very strong demand push. Even right here, this one candle I would consider a demand push. It's very large, right? It took out multiple highs. This is a demand push. Banks are entering right here. Banks are entering right here, right? So then we have a demand zone right here. You can say it's right here, right? Price pushed up, came back down, tapped this box, this demand zone, and shot up. Same thing with over here. Price pushed up, came back, tapped this demand zone, shot up, right? So now you can see when there's a supply and demand zone, most of the time it'll come back to that zone and shoot off with momentum because this is where more banks are entering. All these banks entered right here, but they left some out. So then when it comes back down, all the rest of the banks get in, we push up. Simple as that. And you can see they're everywhere. Right? There's supply and demand zones everywhere, right? Supply zone dropped aggressively, showing us momentum. We know that the banks and liquidity providers entered right here, right? get our box, supply zone, drag it across, look, it came back, tap that zone, dropped aggressively. So we're already adding to our story, right? You want to build a story before you enter a trade. You want to know all the reasons why you're entering a trade where there's no doubt in your mind that you're going to be right. Of course, you can do everything perfect and still lose, but the more confluences you have, the higher the percentage of you winning is, right? So that's supply and demand, right? Very simple. Do not complicate it. We see a big push. We know that there's liquidity pumped in. It's probably a supply zone. So the next thing we want to move on to, right, is gaps in the market. When I found out about gaps in the market, it changed everything that I ever thought I knew about Forex, right? Gaps in the market are so important. So let's erase all this, and you can see right here. This is what you call a gap in the market. If you see this wick right here on this first candle, this wick, the end of it did not touch the third candle top wick right here, right? This wick didn't touch this wick. We're skipping the middle candle. This bottom wick didn't touch the top of this wick. Right? That is a gap in the market. It needs to touch every time. If it doesn't touch, there's a gap in the market and it must be filled, right? I need you to listen to me. 100% of the time, it will be filled. We don't know when it will be filled, but it has to be filled, right? It's just like the rules of the market. So let me show you what I mean. You can see right here, right? So when we think there's a gap, all right, so if we put a line right here at the bottom of this one, and then we put another line right here, right? This gap needs to be filled at some point in time. Sometimes it'll do it instantly, sometimes it'll do it weeks from now, but it needs to be filled and we can use that to our advantage. You can see right here, right? This gap needs to be filled. It came right to the line. Look how precise that is. Came right to the line, and then we made our move to continue down. So these are very important. You need to learn about the gaps in the market. So let's go look at some more gaps, and I'm going to show you that they always get filled no matter what. So you can be very confident with these. So we have lots of gaps right here, right? This is the candle that has the gap, right? So you can just look at it and say, oh, I think there's a gap, right? On the left and right side, there's no wicks touching. So then I'm gonna say, oh, let's verify this. Let's go to the first candle before the candle that we think has a gap, and we're gonna put a line at the top of it, right? Doesn't matter if it's a wick or a candle body, we just gotta go to the very top of it. Then we're gonna skip the candle that we think has the gap, which is this one, go to the third candle, put it at the bottom of that, right? And now we see that there's a gap. So this needs to be filled. So you can see it come and gets filled. Now, not all the time is it just gonna touch it and continue your way, but most of the time it does. But sometimes it'll just come and fill it. The point is we know that this price needs to come here, right? So once we start adding to our confluences, we're starting to build a better story of why we should take it going up or down, right? So that gap was filled. You can see all these gaps get filled. I'm just gonna mark some out, right? Gap right here, skip the middle candle, go to the third one, right? It needs to be filled. It got filled. Every single gap, there's a gap right here to right here, gets filled. Okay, so now I'm gonna look to the left and just scroll to a random spot, and then we're gonna pick some random gaps and we're gonna see how they've been filled. So let's start from this day right here. So you can see we have a gap right here, right? So this bottom wick didn't touch the top of this wick right here, so we have a gap. So then let's go scroll to the right, see if it's been filled. Okay, it's been filled, right? So now we know that price always has to come fill these. So now we got two things. We have a supply and demand zones and how to identify them. Now we know how to find the gaps in the market, and we know that they need to be filled 100%. So let's look at some buy examples. Okay, so looking at this right here, where do you see the demand gap in the market? So what does demand mean? We're looking for buy, so that means we're looking for the candles that are going up and that are green, right? We're looking for demand. We're looking for a gap in the market. So if you said this, you are correct. If you said this, you are correct. Right, these are gaps in the market. So let's get a horizontal ray to confirm it, right? So we think this one has the gap, so we're going to go to the candle before it, put it at the tip of it, right? And then on the third one, we put them at the bottom of the tip. So now we know that this candle has a gap, right? These wicks aren't touching, so this gap needs to be filled. So let's scroll and see if it gets filled, and we can see it got filled right here, right? So now let's move on to the next thing. So the third confluence that we need is we need to have a breakup structure. Now, breakup structures are very important to know what direction the market wants to go in. If you don't have a breakup structure, you are trading blindly. The breakup structure is the confirmation that lets us know, hey, we probably want to go in a certain direction. So let's locate some breakup structures and talk about how the market moves. So the market moves in higher highs and higher lows, right? So higher high, higher low, higher high, higher low, higher high, higher low, right? This high is higher than this high. This low is higher than this low. So then this is a higher high. This is a higher low. This is a higher high because this high is higher than this high. This is a higher low because this one is higher than this one, right? Very simple. Same thing with the opposite direction. Lower low, lower high, lower low, lower high, right? And it just keeps going. Now this is a lower low because it's lower than this low. This is a lower high because this is lower than this high. Very simple. So once we get these lower lows and lower highs, we know that the market wants to continue its trend down, right? Same thing with going up. When we're making higher highs and higher lows, we know that the trend wants to continue up. Okay, so I'm gonna give you guys a couple seconds to mark out the higher highs and higher lows in this situation, right? So starting from here on, where do you see it? I'll give you a couple seconds. Okay, let's start from here. So we got a higher high, higher low, higher high, higher low, right? So it's very simple. Once you know how the market moves, we can anticipate that price wants to go higher once we hit this higher low. Once price made this higher low, we can anticipate that price wants to go higher. So let's look at some more examples. Okay, so from here on, we're gonna be making lower lows and lower highs. So go ahead and mark them up. I'll give you a couple seconds. Okay, so we got a lower low, lower high, lower low, lower high, lower low, right? So now we got lower lows and lower highs. This is exactly what it looks like. So every time we get a lower low and then a lower high, we can anticipate that price wants to go lower to make a new lower low, which it did right here. Price came up, make a lower high, we can anticipate it wants to go lower. So now we make a lower low. So that's how the market moves. So now when it comes to breaks of structure, right? A break of structure is when price breaks out of that trend, correct? So if we have all these lower lows and lower highs, and then price comes and makes a higher high instead of a lower low, now we have a break of structure, right? So we've been downtrending this whole time, and when price was supposed to make a lower high to come make a lower low, instead of making the lower high, it made a higher high, and then it made a higher low, and now price has changed, right? The trend has changed. So that's what break of structures are useful for. So the way to know if you have a true break of structure is you're gonna go to the last lower high that was made, right? So this was the last lower high that was made before this lower low, right? So if price comes and breaks this lower high, I like to do it at the candle bodies, right? So I'll put the line right on these candle bodies right here, because this is the lower high, so I have to put the line right there. If price comes, breaks this and closes above it, we now have a higher high and we just broke structure, right? This is not supposed to happen unless we're changing trend. So now we have a break of structure in the market. This is a great sign knowing that price wants to shoot up. And you can see it did. We started making higher highs, higher lows, and we changed the whole direction. So this is a break of structure. We have an example of a bearish break of structure right before it. So let's go over it. So price was making higher highs, higher lows, higher highs, right? And then we get a break of structure right here at the bottom of these bodies. So since this is the higher low before the last higher high, this would be our break of structure. So we put the line at the bottom of the bodies, right? And if price comes and closes below that, we have a break of structure, which it did. And what happened right after that? The trend changed. It went from making higher highs and higher lows to making lower lows, lower highs, right? So that is a break of structure. This is very powerful stuff that I'm teaching you right here. So now that we went over supply and demand zones, we went over gaps in the market, we went over break of structures. Now we need to put it all together to form this amazing strategy. So now before we get into putting it all together, you need to have this indicator that I'm using, which is called kill zones, right? These are this shaded area right here. This lets us know when we want to be looking for our setup. So all you got to do is go to indicators, type in kill zones by Oscar VS. I'll just put another one on so you can see what it look like. So this is going to show the different time frames for every session, right? So we got Tokyo session, we got London session, we got New York session. Now I trade New York session. It just seems to be the best. So I recommend that you do too. Now, if you can't make New York session, do London. I would never trade Tokyo. But all you want to do to make it look like mine is go to kill zones, go to the settings. You want to turn off every color that's not New York session, right? So we go to the inputs, turn all these off. Tokyo session, London session, turn off. We only have New York kill zones, and then you will get this. So we only want to take trades in this area or an hour before, nothing else. So an hour before New York session, all the way to like 9 o'clock Pacific time. So now that we have that, we know when to look for our trades. Okay, so now I'm going to show you guys how to put it all together. So let's get into it. So first things first, we want to locate a supply or demand zone that we want to be looking for a trade at. So if you can see right here, you have a supply zone right here. We have a supply zone right here, right? So now we got to ask ourselves, which one is breaking structure? So this one is not breaking structure until this candle forms, right? So then once this candle forms, now we're breaking structure. So we say, okay, this is the one we want to take because this is the one that was breaking structure. Then we ask ourselves, was this a supply push? Yes, it was. We have two strong candles showing momentum, letting us know that the banks and liquidity providers entered right here. So we have two things checked off. Now we ask ourselves, was there a gap in the market on the supply push? Yes, there was. The bottom of this candle is not touching the top of this candle wick. So then we will take our lines to confirm it, draw it right there, draw it right here. It's a very small gap, right? They could be very small. They're not always going to be big and obvious. You want to really pay attention. All right, so now that we know that we have this gap, now we're going to draw our supply zone, which we want to take a trade from. And the way you do that is you take your rectangle, you're going to draw from the start of the gap, which is the first line that you drew. It's the start of the gap. And then you're going to draw it to the swing high or the swing low, right? In this case, it would be right here. This is the swing high. So we draw our box up here, and then we drag it across. Now the swing high is simple. When you're going to draw your box to the swing high, you're just looking for the point where price came down, swung up, and then dropped, right? So price came down, swung up. This is the highest point that it went to before it dropped. So it just looks like this, swung up, dropped, right? So swung up, dropped. So we put our box right there. And the reason why we put it at the swing high is because if price comes and breaks that, then we don't want to be in that trade no more because it's going the opposite direction. We're not breaking structure. So once we draw our box from the start of the gap to the swing high, it'll be right here. So now when price comes and taps this, like it did here, this is where we would want to enter. So now that we have our box drawn up, as soon as price comes and taps our box like it did here, as soon as it taps it, we would enter, put our stops to the swing high. And then we'll go for a 1 and 3 minimum. So 1 and 3 is right here. Ended up going for like a 1 and 4. Let's say 1 and 3. You can see that TP was hit, right? No drawdown. Oops. We had no drawdown at all. As soon as it tapped it, we dropped, we mounted into our direction, and we hold for a 1 and 3. So that means we risked $1,000 to make $3,000 or $100 to make $300. Now this is the minimum, right? We can always go for more. You can see right here, when price came back up, it didn't even take us out. Why? Because we put our stop loss to the swing high, right? So if it breaks this, we don't want to be in it. But this is going to keep us safe. You have to put it right there. You can see price didn't stop us out. So we could have held this all the way down for a 1 to 10, bro. 1 to 10 right here on this trade. This is just a random trade that I pulled up. A 1 to 10. So that means if you would have risked $1,000, you would have made 10K in one day from one trade. And you would have to lose 10 times back to back just to be at break even. Not even to be in a loss, just to be at break even. And this is how you become successful, when you have a high risk to reward strategy. So we don't take nothing under a 1 and 3. So if we win a 1 and 3, then we would have to lose 3 trades back to back in order to be at break even, not even at loss. And we don't never lose 3 times back to back. So I want you guys to see how powerful this strategy really is. And this is the reason why I went from being broke to becoming a millionaire, is because I trade with high risk to reward. This is everything you need to change your life. Now, of course, there's a couple things that I'm leaving out that would increase your win rate dramatically and would help you get to your destination fast and help you win more trades. But that stuff is for my course members. And if I was to put it in this video, my students would literally track me down. So I suggest, if you're really going to take this serious, I suggest you join my course, get the missing pieces to the puzzle. We also have a live trading Discord in there where you can see this strategy be put to use every single morning. But I don't want you to go watch another person's video. This is all you need right here. Study this video over and over, back test, trade it live, and you'll see the results. All I ask is for you to hit me up when you get your first payout and let me know it worked for you. I'll see you guys next time. Peace.